Now speaking, Jennifer Driscoll, Vice President, Investor Relations. Good morning, everyone. Welcome to ExxonMobil's second quarter 2023 earnings call. We are pleased to announce that we have acquired Denbury, a leading oil and gas company. This acquisition will help us expand our operations and increase our production capabilities. Additionally, we have included additional information on slide 2 of our presentation. During this call, we will discuss forward-looking statements which are subject to risks and uncertainties. Please read our cautionary statement on slide 3 for more information. We also have supplemental information at the end of our slides. We look forward to providing you with an update on our progress and answering any questions you may have. Now speaking, Darren Woods, Chairman and Chief Executive Officer. Good morning and thank you for joining us today. I'm pleased to report that our second quarter results demonstrate the progress we are making in transforming our business and driving sustained industry-leading performance. We delivered earnings of almost $8 billion, 2 times higher than what we earned in the second quarter of 2018 under comparable industry commodity prices. This reflects our work in the intervening years to reshape our portfolio of businesses, invest in advantaged projects, and drive a higher level of efficiency and effectiveness in everything we do. We also completed the divestment of the Billings refinery, generating cash proceeds of roughly $2 billion year to date. We established 3 new centralized organizations in the quarter, consolidating activities previously embedded in each of our businesses: Global Business Solutions, ExxonMobil Supply Chain, and Global Trading. In the Permian, we set another production record and remain on track for an overall growth in production of 10% this year. In Guyana, we achieved a record quarterly gross production rate of 380,000 barrels per day. In the Gulf Coast, we achieved mechanical completion of the Baytown chemical expansion, which grows volume and improves mix with 750,000 tons per annum of additional performance chemical products. In Golden Pass, the last of our Growing the Gulf projects should have its first train up at the back end of 2024. We announced the CO2 offtake agreement with Nucor, one of North America's largest steel producers, and signed an agreement to acquire Denbury, which will provide ExxonMobil with the largest owned and operated network of CO2 pipelines in the United States. We have agreed to transport and store 5 million metric tons of CO2 per year for customers, equivalent to replacing 2 million cars with EVs. With the planned Denbury acquisition, potential reduction could be up to 20 times that. We have achieved structural cost savings of $8.3 billion and remain on track to reach our target of $9 billion in savings by the end of this year. Cash flow from operations totaled $9.4 billion in the quarter, or $13 billion, excluding the change in working capital. We distributed $8 billion in cash during the quarter, including $4.3 billion in share repurchases and $3.7 billion in dividends. Bank of America Merrill Lynch analyst Doug Leggate inquired, "Darren, what progress have you made on the $9 billion cost-saving target through 2027? Darren Woods replied, "In short, our reorganizations have enabled us to capture efficiencies across the enterprise. We are now able to identify opportunities to take advantage of scale and synergies between integrated businesses. We anticipate further cost reduction as we move forward and will provide an update on the opportunity at the end of the year." Kathy Michaels replied, "Doug, at our Investor Day in March 2022, we outlined the impact of cost savings on earnings relative to volume and mix. If you review the materials, you'll get a good idea of the magnitude of the effect." Goldman Sachs analyst Neil Mehta inquired, "Darren, what is your perspective on the current M&A market and how are you looking to create value through potential opportunities?" Darren Woods replied, "Good morning, Neil. Our perspective on the space of interest hasn't changed. We're looking for opportunities to create unique shareholder value, where 1 + 1 = 3. We're leveraging our competitive advantages to open up value opportunities that others can't achieve. We're making great progress in this area and advancing our technology portfolio, which increases the potential for unique value opportunities with other companies. However, we won't compromise our expectation of generating returns and growing value for shareholders. We remain picky acquirers." Morgan Stanley analyst Devin McDermott inquired, "Could you please explain the specific drivers that allow you to achieve a higher NPV than other cube development in the Permian Basin? Could you also address the resource recovery trends and potential for further upside?" Darren Woods replied, "I'll start by saying that our approach to the unconventional space since 2018 has been to leverage our scale and balance sheet to develop assets at scale. We call this cube development, which is focused on maximizing overall recovery rather than near-term production. This approach has been validated over time and is reflected in our current results. We are setting records for lateral well length, which lowers costs, and we are trialing technologies to maximize recovery. We have seen encouraging early results, but they are not yet at a scale to be fully reflected in our results. We remain confident that we have moved to the front of the pack and there is still upside to come." JP Morgan Chase & Company analyst John Royal inquired, "What are the drivers of the $2 billion negative margin decline in Exxon's energy products?" Kathy Michaels replied, "There's nothing unique to us. We're just seeing the same reduction in margins that the rest of the industry is seeing, and it's just a bigger absolute number because of our larger footprint in the U.S." Darren Woods replied, "Absolutely. Our refining business is significantly larger than our competitors, so any changes in margins have a greater effect on us than on them." Wells Fargo Securities analyst Roger Reed inquired, "What can you tell us about the outlook for chemicals margins given the potential increase in China chemical capacity?" Darren Woods replied, "Our diversified feed slate and integrated refinery network have enabled us to respond quickly to changing market conditions and price signals. This has allowed us to remain profitable even in a challenging market environment. Our investments in chemicals over the past 5 years have paid off, as all of these projects are cash and earnings positive. This positions us well for when the market returns to top of cycle." Kathy Michaels replied, "Our geographic footprint is an advantage, as we are 35% larger in North America than the rest of the industry. We have implemented projects that have helped to improve our overall mix, resulting in a 6% increase in performance chemicals products this quarter, which carry higher margins." Wells Fargo Securities analyst Roger Reed inquired, "Given the expected rise in global coal and oil demand, is there any additional pressure to accelerate carbon capture initiatives?" Darren Woods replied, "I think what we're seeing today is a reflection of the challenge the world faces in reducing emissions. We've been advocating for and developing solutions that weren't initially accepted, which has slowed progress. Now, there's recognition that we need more solutions and the industry can provide them. We're in the early stages of this transition and need as many solutions on the table as possible. We're leading the way in the molecule-oriented parts of the business, with investments in third-party emission reduction opportunities that no other company has. We're delivering on our ambition to lead the industry, but there are still elements that need to come together for success. We're also working on technology advances to reduce the cost of emissions reduction, and hope to commercialize some of these technologies in the next few years." Wolfe Research analyst Sam Margolin inquired, "What is Denbury's stance on ER barrels being credited with carbon attributes?" Darren Woods replied, "I would say that Denbury's core business is not a strategic driver for us, but ER can play a role in the short term. We are focused on carbon capture, storage and sequestration, which is a longer-term play. We have a Class 6 well Permian that is required for sequestration, but progress has been slow. ER provides us with optionality in the short term, allowing us to keep our schedule while we work on the sequestration side." Evercore IC analyst Stephen Richardson inquired, "Could you please explain the debottlenecking opportunity in Guyana and how it could benefit your other projects?" Darren Woods replied, "Our organization has spent decades working on optimizing our projects. We have 3 main areas of focus. First, we have a strong project organization that designs and builds our facilities to maximize production while staying within safe operating limits. This organization has been successful in optimizing many of our facilities, and we expect the same for future projects. Second, our operations organization is focused on maximizing utilization and production. They run our facilities reliably, safely, and in an environmentally responsible manner while maximizing the value of our assets. This organization has been successful in maximizing value across all our capital projects. Third, our technology organization has been consolidated and is now focused on driving innovation and creativity. This close partnership with the business has led to more technology being implemented in the field to assist operations and further optimize production. We expect to see the first 2 FPSOs, floating production, storage, and offloading vessels, reach production levels above 400,000 barrels per day as we continue to optimize. We also anticipate similar improvements with the third boat, Para. As we move forward with future projects, we expect to continue finding optimization opportunities and benefiting from our inherent capabilities." Piper Sandler analyst Ryan Todd inquired, "Can you discuss the drivers and headwinds that impacted upstream performance in the quarter, particularly related to pricing and trading?" Darren Woods replied, "Kathy, I'd like to hear your thoughts on the pricing and market environment. As I mentioned, our quarter came in pretty much in line with what we had expected based on the 8K that we put out. Refining margins are down a bit but still in healthy territory. We anticipate that as demand picks up in the back half of the year, supply/demand will tighten up and we'll see some upward pressure on prices. Do you have any additional insights?" Kathy Michaels replied, "Our gas portfolio is now 45% LNG, with Henry Hub and TTF prices down 40 to 50% respectively. Additionally, our LNG contracts are tied to lagged oil prices, which were down roughly $10 a barrel in the fourth quarter. Excluding mark-to-market, our gas trading results were lighter this quarter." TD Cowen analyst Jason Gableman inquired, "What is your view on lithium drilling and refining, given your expertise in drilling and refining of materials in the ground? Was this development contemplated in the $17 billion energy transition budget?" Darren Woods replied, "ExxonMobil is leveraging its advantages to explore the potential of participating in the transition space, particularly in the production of lithium from brine water. This requires a good understanding of the subsurface, reservoir management, drilling and injections, which are all capabilities that ExxonMobil has built up over decades in its upstream business. The processing of the brine and extracting the lithium is also consistent with the company's refineries and chemical plants. ExxonMobil is evaluating the opportunity and believes that by applying its advantages, it can bring on a much-needed resource at a lower cost and with less environmental impact than open mining. This could be a win-win-win opportunity for the company, the environment, and the markets that need lithium for electrification and EVs. UBS analyst Josh Silverstein inquired, "Can you foresee Exxon going into a net cash position next year if the forward curve holds the current strip?" Kathy Michaels replied, "We're pleased with our balance sheet position. We anticipate our cash balance to fluctuate based on the commodity and margin environment. We're not limiting ourselves from investing in capital projects that can generate good returns for our shareholders. This will enable us to support competitive dividends and a consistent share repurchase program. We intend to maintain a higher cash balance than usual to give us more flexibility in managing the company over the long term." Darren Woods replied, "The mandate to our businesses is to find projects that position us ahead of the competition and deliver high returns and value. We will fund these opportunities as they come forward, but what limits our investment is the ability to identify and develop these opportunities. Our organization is focused on finding these opportunities that are robust to a low-price environment, ahead of other companies, and tap into the long-term fundamentals of the market. When we find these opportunities, we will fund them to generate long-term value for the corporation and our shareholders." Truist Securities analyst Neil Dingman inquired, "Darren, what are your thoughts on OFS costs for the remainder of this year and into 2024? Are you expecting inflation or deflation?" Kathy Michaels replied, "Inflation has been a concern for us, but we're starting to see deflationary pressure in certain cost categories, such as chemicals and tubular goods. Labor costs, however, have yet to experience this deflationary pressure. We anticipate that inflation will continue to decrease in the second half of the year and into 2024. Scotiabank analyst Paul Cheng inquired, "Darren, what is the expected total spend on low-carbon business through 2027 following the Denbury sale acquisition?" Darren Woods replied, "Thanks, Paul. I think the Denbury acquisition was not part of the $17 billion. We're just starting up that business and have made progress in bringing opportunities to bear, such as the 3 big customers we now have, and demonstrating that we can decarbonize hard-to-decarbonize industries. We've also got a significant investment opportunity in Baytown for the world's largest hydrogen plant, and opportunities for low-carbon ammonia. With the announcements of the deals we've got to date, there's recognition and interest from potential customers that there's a real opportunity here. The $17 billion was looking at a portfolio of opportunities and assessing how quickly they'd manifest and the capital required. As we continue to develop and make progress on these projects, some of the capital becomes more discrete. The Denbury acquisition, if it goes through, will allow us to pull back on some of the grassroots investments and substitute with the assets from Denbury. We won't compromise on our return criteria or advantage criteria for the projects we bring to bear. We have to be low-cost suppliers, leverage the advantages of the corporation, and generate good, competitive returns. That will dictate the pace and size of the capex. As we go through this year's plan, Dan and his team are focused on executing and driving the business to develop more detailed plans and update that number." Kathy Michaels replied, "ExxonMobil's CCS business has a backlog of 5 million tons annually, which is equivalent to the number of cars on the road in the U.S. today. This backlog supports the growth of capex and profitable growth of the business. The overall CCS opportunity across the Gulf Coast is 100 million tons annually, which is 20 times the current backlog." Sankey research analyst Paul Sankey inquired, "What is the expected recovery of upstream volumes in Q3 and for the rest of the year?" Darren Woods replied, "Paul, in the first quarter we saw a significant increase in production compared to our plan for the full year. We are currently on track to meet the 3.7 million barrels a day of production that we projected last year. We are working hard to exceed this goal, but at this time, we feel confident that we will meet our plan." Sankey research analyst Paul Sankey inquired, "What caused the downtimes in Q2?" Kathy Michaels replied, "We guided for a reduction of 110 cob due to divestments and scheduled downtime, but the actuals were 120 cob. The overall production was down more than that due to OPEC production cuts and an unscheduled strike in Nigeria. We still remain on track to reach our full-year guidance of 3.7 million oil equivalent barrels a day, with a year-to-date increase of 15,000 barrels a day year-over-year." Sankey research analyst Paul Sankey inquired, "Can you provide more insight into the positive growth of energy product sales, particularly in Beaumont?" Kathy Michaels replied, "Beaumont was running at 90% utilization, which contributed to our strong quarterly performance. This is a testament to the operational excellence across our company." Jennifer Driscoll replied, "Thank you all for joining us today. I'm pleased to announce that ExxonMobil will be hosting a Product Solutions Spotlight on Wednesday, September 20th at 1 p.m. Central Time. Jack Williams, Senior Vice President of Product Solutions, and Karen McGee, President of Product Solutions, will be joined by other ExxonMobil leaders to discuss the new group formed in April 2022. For more information about this event, please visit the Investors section of our website. That concludes our Q&A session for today. Have a great weekend.